Hello and welcome back. It is October 20th, 2022, week 4 of fall term. I am Ryan Hogan, the large cap portfolio manager at the Oregon State Investment Group, and our current value is $3.24 million. Quickly diving into our weekly performance overview, we returned 28 basis points versus the S&P at negative 11 basis points for this week, generating a weekly alpha of 38 basis points. This was a good week for us. Our year-to-date return sits at 22.5% down versus the S&P at 21.94%, or almost 22%. This again is returning us a year-to-date alpha of 3.28%. Negative. We're really trying hard to bring this metric up. It's a measure of our performance relative to the S&P 500 and the risk-free rate. Our 1-year beta is sitting at 0.88 versus the year-to-date beta at 8.9. Nothing changing here from last week, but again, the S&P having that beta of 1 versus us having a lower beta and us being undercompensated means that our Sharpe is definitely going to take a hit, and that's exactly what we see here. We have a negative 0.107 Sharpe versus the S&P 500 of negative 0.72. Again, if you look at that equation and that formula, which I may go into in a later video, you'll see that you're taking out that risk-free rate and dividing it by the standard deviation of your portfolio. So again, we're being undercompensated for our risk, which is not great. Despite the undercompensation via the Sharpe ratio for 1 year, our inception return is still above the S&P, which is always good to see. U.S. Treasury yield curve and economic data. Jumping right in, I have the yield curve chart plotted up here today versus last month, and then the change. Shorter term maturities saw the highest change or delta, and this week the U.S. Treasury started selling a 4-month to expiration T-bill. This is a new product for the Treasury to offer investors. I'm not sure why they did this. There's a lot of market turmoil, a lot of volatility. I'm really uncertain as to why they added this to their offerings, but nevertheless, we are still in an inverted and somewhat flat yield curve. It's a rare type of yield curve when interest rates on medium to short-term maturities are higher than the rates on both long and short-term maturities. As you can see, the 6 through the 5-year maturity, or 6 month through the 5-year maturity, are higher than the shorter term maturities, which is expected, but are also higher than the longer term maturities, which is unexpected. So investors seem to be selling out of these maturities, causing the yields to rise and buying the longer term and shorter term maturities, which is not a great sign for the overall market. Cost of capital is going up and lowering the return on investment for investment projects and just overall stock investments or equity investments from investors. But these investment projects, as the cost of capital goes up, it's disadvantageous to deploy your capital to some of these lower yielding projects, which may or may not indirectly or directly benefit the company in the longer term. And that's exactly what you're seeing with Amazon and the amount of investment that they're doing. They're eating up their free cash flow in order to continue the investment wheel, and it's just not helping them, and investors are discounting their stock because of it. Jumping back into the yield curve, the main fear for the market is that the cost will continue to rise if the Fed continues to raise interest rates, which I currently believe they will. Again, this is going to drive down future returns both in the equity markets and on individual businesses as they go to make investment projects or do capital expenditures. This curve typically happens when interest rates are expected to rise then fall. Again, I talked about this last video. Fed funds rate as of now is 3.25 according to bank rate, and the next Fed meeting be on the lookout for is November 1st through the 2nd. On November 2nd, we will know as a nation and as a world if the Fed is going to continue to raise rates and at what percentage rate. 75 basis points seems to be the consensus. We have some investors becoming optimistic and betting on a 50 basis point raise. I personally think it's going to be 75, but you may even see 1% due to the latest CPI report. In international news, Japan tried to raise funds for the government and nobody bought their government funds. The currency devalued pretty significantly if you look at the Japanese yen. I threw a little article headline that I found interesting. Japanese yen hits 150 against the US dollar, weakest levels not seen since August 1990. We have a really strong dollar right now. It's going to hurt big tech. It's going to hurt any company, any real service-based company that does business overseas. Will this materialize in the earnings report of this quarter? Maybe. My prediction is it'll come next quarter, but again, we don't know. And just a quick note here for all our new analysts here at OSIG, the US dollar is the reserve currency of the world and acts as a safe haven for assets. Here's a portfolio update, midterms and earnings season incoming. Again, I had this chart up last week, but I will show it again. Over 800 companies will be reporting through the 24th through the 28th of October this year. And then you roll directly into midterms. So expect higher volatility in either direction. The VIX being at 30, 31, 32. I think that you'll see the VIX come down a little bit after midterms, after elections take place, and especially after earnings. But again, we'll see. Here's my portfolio plan for the rest of the year. I want to match the S&P 500, but be underweight technology and overweight in healthcare, real estate, consumer staples, industrials, and consumer staples. And my thesis behind this is tech will continue to get hit. Those that are raising or doing debt financing, they're going to continue to sell off as the Fed raises rates. It's not going to be a pretty picture for the NASDAQ. And I want to reduce our portfolio's exposure to any technology or enterprise relational or enterprise resource management or processing software company besides Microsoft. I'm a big believer in Microsoft because of what they're doing in the cloud and for their customers. They're a big subscription revenue king, and I really like the subscription revenue software as a service business model. I think it allows companies to forecast more effectively. It allows businesses to predict where cash flows will be and make investment decisions accordingly. This is going to reduce cash flow and revenue volatility that you see in some of these other more cyclical businesses that are not at all subscription-based businesses. Dividends and other metrics. Over $1,700 coming in from Medtronic, US Bank. We sold 25 shares of Pioneer over the week, brought in about $6,400. We're still overweight this stock. The stock pays a huge dividend. We made between 9 and 10,000. I will get the actual number out at the next meeting, but over the summer, because of their special dividend and the regular dividend, we made between $9,000 and $10,000 off the dividend alone. Again, that's a $250,000 position in our portfolio, so we're still overweight. We're bringing it back in, but it keeps growing. We sold 100 shares of PayPal. My plan is to fully shave out of this position by the end of fall term. That individual transaction brought in $8,600. This is a typo, but we sold 15 shares of Lockheed Martin for $6,600. I wanted to lower industrials just a little bit, and then we bought 20 shares of Adobe for $6,100. We bought 150 shares of Verizon. We're trying to raise our communication sector allocation. Google, in my opinion, is a better company, but I don't want to be overweight Google and skip out on kind of the deep discount Verizon is seeing right now. I think Verizon's a stable business. I like their catalyst for 5G. I like kind of their monthly payment system that they have. It's subscription revenue. They're not going to see 20% revenue growth, but they're not going to see 20% revenue, I guess, drawbacks. So we'll see. Currently we have 28 holdings plus cash. and as of this morning we have $75,214 cash. We'll be adding to our positions through October earnings. And just a note on how I trade for all the new analysts. I trade gradually, or really dollar cost averaging. I think it's a better way to trade. I try not to do block trades where I move, tens of thousands of dollars worth of stock in a single day. I want to minimize doing that, and hopefully the portfolio manager that takes, my position after I leave and after I graduate will do the exact same. Thank you for tuning in. As always, I'll see you next week.